So as I mentioned, I divided the retirement section into two categories. One is tax deferred and one is tax free. What I mean there is your tax deferred accounts and tax deferred investments are treated differently, and you should invest differently than your tax free. Tax deferred meaning things like your 401k, your IRA, 457, pensions, your SEP, KEO, and self-directed IRA accounts as well. These are all tax deferred, means that the government has deferred taxing the dollars that you put into this account. So let's say hypothetically you make $50,000 a year and you put $5,000 into this into a tax deferred account such as a 401k plan, which then is invested into mutual funds inside of that 401k. Then that $5,000 is working for you before being taxed. So the government looks at it like we will charge your tax on $45,000 of income versus $50,000 of income. So the $5,000 is growing before any taxes has occurred. So it's basically like if you ever watched Bugs Bunny and a snowball rolls down the hill, and it starts off as a small ball, and it grows 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 and it grows. By the time it gets to the bottom of the hill, it's this giant snowball. Well, that's tax deferred investing, and with compound interest. So it's definitely, it's something that most Americans do, and you should understand how the account works and the tax deferred status of these investments, and understand the difference between tax deferred and tax free. Now, your tax free accounts would be things like your they have Roth 401ks as well, but most commonly known is a Roth IRA account. And basically those are types of accounts that the tax has already been taken out of your pocket, and those investment dollars have been taxed already. So when you withdraw funds upon retirement, you don't have to worry about paying tax on that like you do in a tax deferred account. You pay the tax at the end. Well, in the tax free accounts, you've already paid the tax. Now, other things that could appear in a tax free account are things, insurance products, because remember, proceeds from an insurance product are not taxable. So for instance, a variable universal life insurance policy, I'm a fan of those. It's controversial. Some financial advisors that I've seen on television say shy away from those. I haven't heard an intelligent reason why you shouldn't, other than that it gets the advisor a higher commission, and it does. They'll make more money off of you if you buy a variable universal life insurance policy. Why are you worried about what they make? This is a good product for you, and not for you, for some people. But the point is that the growth in the variable universal life insurance policy, when you pull that cash out, you pull it out as a loan to yourself, and it's not taxable. So, and there are a lot of other aspects to these insurance policies that are favorable, and with every pro there's a con. So again, when you sit with your financial advisor, listen to him, weigh the pros and cons, ask questions, and see if it's the right kind of policy for you. Never mind what the person on television says. So to recap, the essential components of a financial plan involve cash and cash flow / household budget. There's emergency fund. Some people refer to it as rainy day fund. There's the protection, which are some form of an insurance policy. Could even be a family trust fund to protect assets, but I didn't go into that, but that's included in protection. And then we get to your investment goals, and which all have an investment assigned to them. And then we talk about retirement, and we divided those into two sections: tax-free and tax-deferred. Now I want to recap and go back and highlight how does a real estate investment, how does it work in, how does it fit in, and how does it benefit you in your overall financial plan.